Hi, I'm Gary Stone. I am a Senior Portfolio Manager and Senior Business Development Officer for First National Wealth Management, working out of the Damascotta, Maine office. We're hearing a lot about the recession these days in the news. No one wants to see a recession, but they're not uncommon. They happen every few years and typically don't last nearly as long as the public might think. There are often clues to an impending recession. Analysts tend to look at something called the yield curve. It's a plot of interest rates from shorter term out to longer term periods in time. An inverted yield curve is when short-term rates actually rise above long-term rates. You might ask, well, why is that important and what does that mean? Well, what a yield curve is doing is it's trying to predict the future. It's essentially a crystal ball. And if short-term rates are higher than long-term rates, what that typically means is that the market is concerned about the health of the economy farther out in time. So an inverted yield curve very often is a precursor to a recession because it essentially is predicting a slower economy farther out in time. Recessions typically last an average of 10 months to a year. What comes as a surprise to most investors is that equities tend to perform fairly well during a recession. It's actually the year before the recession where the stock market tends to suffer. And that's because the market is actually looking forward to the recession. Markets tend to be what are called discounting mechanisms. In other words, they're taking today's information, discounting it, and trying to predict what's going to happen in the future. So what happens once we get in a recession? Well, historically, equity markets tend to perform fairly well. Typically, the markets are only down 1% or so during the recession. So what we're recommending to our clients, what you want to own during a recession, is you want to own companies that have strong balance sheets, companies that perhaps have a lot of cash on the books, a lot of free cash flow, companies that don't have to borrow. That makes sense. If interest rates are higher, that means borrowing costs for all companies are higher. So a company that doesn't need to borrow as much, that has cash on the books, will be less affected by higher rates. Also, we would recommend investment-grade bonds. Why? As interest rates have gone up, the value of bonds have gone down. It's an inverse relationship. Rising rates lead to lower bond prices. So you want to buy bonds when they're less expensive. And coming out of a recession, one that's caused by higher rates, bond prices are much more attractive. The idea of us heading into a recession is a concern for many of our clients. If you have concerns about the next recession, whether we're going to go into one or what happens if we do, please reach out to me. I'm easily found, First National Wealth Management in Damascotta, and I'd love to talk to you about how a recession might affect your portfolio, but also how you should be looking beyond a recession because history proves that markets do recover and that recessions very often are nothing to fear as an investor.